Running a small business means wearing many hats, and unfortunately, tax expert isn't always one of them. Every year, countless entrepreneurs leave money on the table by missing legitimate business deductions. If you're ready to stop overpaying the CRA and keep more of your hard-earned profits, this video is for you. Home office expenses. Your home can be a tax haven. Many small business owners operate from home but fail to claim all the allowable expenses. If you're running your small business from a dedicated office space in your home, you're sitting on a gold mine of deductions. Here's a list of some things that you can deduct. A percentage of your rent if you're a tenant. You can deduct property taxes and mortgage interest if you own your home. You can deduct utilities like heat, water, and electricity, home or renter's insurance, internet, specifically the portion used for your business, and cleaning materials and even maintenance. The key here is that your deductions must be reasonable and based on the square footage your office occupies of your home. So get out your tape measures and calculate how much square feet your office takes up, and then calculate that as a percentage of your total home square footage. For example, if your home office takes up 10% of your total home square footage, then you can deduct 10% of the expenses that I just listed earlier. The second commonly missed deduction is vehicle expenses. If you use your personally owned vehicle for business, many of the related costs are deductible, but only the business use portion. This is where many entrepreneurs miss out because they don't track their mileage properly. Here are some of the deductible vehicle costs: fuel and maintenance, insurance premiums, lease payments or your interest on financing, and licensing and registration fees. Here's the critical part. You must keep a detailed logbook of the miles that you drive for your business. The CRA takes this very seriously, so be sure to track the kilometers driven, the date, the purpose of the trip, and who you were meeting with. Then, similar to your home office expenses, you can calculate your total vehicle deduction based on the percentage of kilometers you drove for business compared to the total kilometers driven that year. Now, you might be wondering, what about parking? Well, if you pay for parking to meet with a client or for an event or networking, the entire amount of the parking fee would be deductible because it's specific to that business event. However, if you pay monthly for parking to store your vehicle on a regular basis, then you would have to apply the percentage that you actually drive for business to your total parking fee to calculate the business use portion. The third commonly misunderstood deduction is meals and entertainment. The simple rule is you can deduct 50% of legitimate meals and entertainment costs for your business. Now, here's a list of what qualifies as a legitimate business meal or entertainment. If it's a client lunch or dinner, networking events, coffee meetings with stakeholders or other potential clients, business conferences and seminars, and meals while you're on the go during a specific business trip. And this trip must be solely for business purposes. An important thing to note is meals while you're alone or just on the go commuting to work are not deductible. The meal must be specifically with a client or other stakeholder to discuss business. The fourth commonly missed deduction is capital cost allowance. Instead of deducting the full cost of equipment or vehicles in the year that you buy them, the CRA requires you to spread out the cost year over year through capital cost allowance. If your business owns a vehicle and you purchased it in cash or with financing, you would deduct depreciation for that vehicle over time through capital cost allowance. Of course, if this vehicle is 100% owned by the business and 100% used for business, then all related costs would also be deductible. Many entrepreneurs also forget to claim capital cost allowance classes correctly. For example, most passenger vehicles fall under class 10.1, which has specific rules and limitations. So getting this right can save you significantly over time. The fifth deduction is your telephone and internet expenses. Your communication costs are largely deductible, but it depends on how you use them. If you have a dedicated business phone line or internet connection, then it would be fully deductible. For personal plans used partially for business, You would just deduct the percentage that you use that phone plan or internet plan for business. Again, it's important to keep detailed records to prove how much you used your phone for business versus personal. Number 6 is another commonly overlooked deduction, which is gifts. Small gifts to clients or suppliers can be deductible. This is often overlooked and can really add up, especially when you like to celebrate big milestones with your clients. Number 7 is also really important. This is training and professional development. It's really important to invest in yourself, and it's also a great business deduction. Courses, certifications, or conferences all relevant to your business are deductible expenses. The key requirement is simply that the training is directly related to your current business operations, not for learning a completely new trade. This deduction encourages continuous learning and can significantly impact business growth, all while being a great tax write-off. And the final commonly missed deduction is bad debts. Simply put, that's when your customers don't pay you. If you've included an amount in your business income that your customer never actually paid, you may be able to deduct it as a bad debt. This helps offset any tax that you paid on income that you didn't actually receive. You'll also need to demonstrate to the CRA that you made reasonable efforts to collect the debt. Even with the best intentions, small business owners often make costly errors when it comes to tax deductions. A common one is personal expenses flowing through your business account. That can be a major red flag with the CRA. Always keep your personal and business expenses completely separate. I always recommend to make sure that you have a completely separate business account for all business transactions. Having a separate business account will also allow you to build a relationship with a certain bank that can come in super handy for securing financing later on. It's also really important to keep all receipts, even for the personal expenses like your home office, your personal vehicle, and all the other expenses we discussed earlier. It's so important to keep receipts. Something else that's really important is keeping proper receipts for all your home office expenses, your vehicle expenses, and of course, every business expense. The CRA may deny a legitimate deduction if you can't provide proper backup for it. It's also really important to track those business kilometers so you can calculate an accurate percentage of how much you drove for business. It's also important to understand what counts as a capital asset versus a current expense. Some purchases can be expensed in full in the year that you buy them, and others need to be capitalized as an asset, and then you claim capital cost allowance against those purchases. The most important thing is to take action today. Tax planning isn't just about April. It's a year-round strategy that can dramatically impact your bottom line. Start by implementing a simple tracking system for your expenses and keeping detailed records. Remember, every legitimate deduction you miss is money out of your pocket and into the CRAs. Your business works hard for every dollar. Make sure you're keeping as much of it as legally possible.